Welcome to episode 33 of the Corporate Real Estate Insider podcast. We have an awesome episode today talking about a few really interesting developments happening out there in the corporate real estate world. Most notably, there was just a massive high-rise office building that just sold for almost nothing, additional symbolism of the Class A high-rise doom loop that we're in. Owen, I know you wanted to talk about this to kick us off here.
Hello, everybody. So you might have read in the Wall Street Journal about doom loops, and they've been discussed for quite some time, especially since the pandemic. You know, even at one point, San Francisco was coined to be in what they call a doom loop. And basically, it's a place, for those that haven't heard about them, where people just don't go because there's just nothing to do. And so think about, this like cycle where you've got shuttering retail, you've got nobody going to the office, you have no reason for people to go downtown for civic opportunities, cultural opportunities, and that's what's unfolding right now in St. Louis. It's rather sad. There was an article in the Wall Street Journal about it, and that doom loop crisis is indicative of what just happened, which is quite possibly the most astonishing capital markets trade I've read about in possibly my career. And it's about one of St. Louis's tallest office towers, which, by the way, has been empty for years, sold for less, get this, people, less than 2% of its peak price. So think about that. In 2006, this building called AT&T Tower, sold for $205 million. And it sold last week for $3.6 million at auction. So again, in 2006, somebody paid $205 million for a building that now just sold for $3.6 million. I joke because it's hard to not think of a thesis where you just buy it, hold it for 10 years and sell it, when the market comes back. But maybe the market won't come back. Maybe this doom loop will be perpetual for these non-coastal cities that don't have a lot to offer, where they're in this like ever damaging doom loop cycle. And it just shows what's kind of going on right now with some of these downtowns. And a lot of this, like it or not, is attributed to the lack of demand for office space. We've been talking about this for over a year on the pod, and that's not reason to be in the office necessarily, but it's just what's happening as a product of all these people that used to go downtown to go to work, to shop, to eat, etc., who now opt for suburbia or just working from home, the effects it has on these downtowns. And I think it's a good wake-up call for any city, including my own here in Seattle, of what can happen, if we don't invest in our urban centers. And so for St. Louis, it's a tall order. What did they do with a 44-story, 1.46 million square foot tower? Think about that, people. I mean, for those that know Seattle, our tallest building is approximately about that size in terms of its square footage. So this is a massive building, 1.46 million square feet. For most markets, less maybe, New York, that's a very, very large building. Do they convert it to residential? Do they do multi-use? Who knows? The owner has got to figure that out. It's a Boston-based firm called Goldman Group. So it'll be interesting to see, but nevertheless, it's a wake-up call, in my opinion, for cities across America that are not investing in downtown in light of the changing demographics of those who occupy it day, nights, and weekends.
Yeah, Owen, we've talked about it on this pod before. It's this idea that, congratulations, you're the lucky owner. Now you get to pick up the carrying cost. I think it's entirely empty, and it needs a massive investment, whether you're going to convert it to multifamily or not. Even as an office building, if it's going to compete in this new lackluster market, it's going to require a ton of money going in. So I think on the pod, we came up with the idea that the building was worth nothing today because of the cost to get it to a leasable condition. But here's what I wanted to say. I read that article as well. Did you see the quote from the gentleman at the Goldman Group? What are your plans? What are you going to do? And he basically said, I don't know. We're still digesting this, which I don't know how you interpret that, but it also interesting to note it was sold on the CoStar 10X auction platform. So what it sounds like is these guys said, let's take a run at this thing. What's it worth? Zero. We can't bid zero. And so they picked a number, they put it out there, and they won. And now they're like, oh, They're still digesting it. So I'm not even sure they're excited. They must be. I'm sure they did their due diligence, but there was a really profound quote. They're still digesting the fact that they want it.
Yeah, and they bought it in a downtown market that has 19% vacancy. And remember, vacancy is not equivalent to availability. So availability, I suspect, in downtown St. Louis exceeds 20%. So yeah, they've got 1.46 million of square feet of space to do something with. And I'm actually excited to see what they do. It will be fascinating because their basis is very low, but their cost to do what they want to do could be very expensive.
We might be waiting until we're retired to see what their scenario plays out as. I mean, if you think about it, they're going to have to work with the city. Their tax base, say it's $10 a foot, it's $14 million just in taxes. Your operating expenses are probably similar just to keep the building from, turning into a wasteland. So you're $20 to $30 million just to carry the thing. They'll go to the city, get a TIF on the taxes to try to get that to zero. They'll try to figure out a way to do something with the building, maybe short-term, long-term. But this is the equivalent in this market with that cost in this building of going to a casino and, putting it all on black and just hoping and praying. And at $2.5 million or whatever they paid for it, I mean, that's effectively what it is. I mean, these downtowns, I think the bigger picture that I look back on in my career is, I was working on a project in downtown. The client was in downtown Memphis, and they had 75,000 feet, and they had a couple hundred people, and it was, it was it was a professional services company you all know about, one of the largest in the world, and their lease was coming up, and everybody wanted to move to the suburbs, and it became this kind of socioeconomic issue where, like, you create a doom loop. The more companies that move to the burbs, and this company, who does work with the city, who does work with the state, who does work with the federal government, had all sorts of pressure on them to stay downtown, because the more people that leave, the more people that leave, and it just becomes this self-fulfilling prophecy. And Memphis at the time was in real trouble, and the burbs were like where everyone wanted to be. And they did a scattergram, and they looked and said, our people are no one's living downtown. We're not going to be here if no one's living here. Let's make the decision like we'd make the decision without all of this external pressure. And they moved out, and the city went through a real trouble over the next period of time. I mean, on the flip side, I was working with another client in Minneapolis, and they were in the burbs, and their leadership was like, we want to renew or stay right around where we are. And we came in as the real estate team under a really strong real estate leader and said, let's take a step back and let's do the scattergram. Let's figure out where our people are, where they're moving, where they're living. And at the time, Minneapolis was bringing lots and lots of young people downtown. They had a lot of residential under construction. They had a lot of delivered residential that people were living in. And they had their younger staff was all living downtown. They wanted to work downtown. So the leadership was like, holy cow, this is real. This isn't something, we didn't think it was this prevalent. And they made the decision to reinvest in downtown in an old historic building that was being converted, similar to this, but a much smaller scale. It's like 300,000 feet. And this particular client took a huge investment in that building. We had to deal with, the lease, as we were negotiating the lease, they're abating asbestos in the building. That's, it was a very challenging lease because there was a lot of difficulties and protections that we needed because it was the preservation and restoration of a historic building. Like, if you think of this building in St. Louis, it's old. No one's touched it. Like, you walk in there, you pick up the flooring to just do some demo, and you could be hitting mastic for anything. It could be asbestos. It could be lead paint. Like, you don't know. And then all of a sudden your cost structure goes through the roof because you got to, envelop the thing in plastic and remediate. So I feel for those people, but, they're Boston crew and they're smart. Today's, some of the smartest people in the world come from Boston, and a lot of pride in the city today. So I'll say that. I'm sure they'll do great. And, as we're filming this, it's the day of the Boston Marathon, the oldest marathon in the world. One Boston Day, Patriots Day, if you didn't know that, it's the anniversary of the Battle of Lexington and Concord. I have to get my Boston props in here, guys. I know I kind of went off target, but Goldman Group being from Boston, it gave me an opportunity, and yeah, I'll leave it at that. But a lot of Boston pride on this side of the microphone.
Now everyone knows Brian's investment thesis is if, just back Boston exclusively, screw everyone else. But yeah, so really interesting. The CEO of Vornado Realty, which is one of the largest office owners in the country and own a massive amount of space in New York City, was recently interviewed, and he says that he thinks that 60% of all properties in New York are well past their prime and are old, tired, and he even said obsolete. So you start thinking about if 60% of the real estate in Manhattan is obsolete, what percent of real estate in like St. Louis or in other cities are obsolete? And I think we're really, this is just the beginning, right? Like this particular, 1.46 million square foot building that we've been talking about that sold for next to nothing, that cost probably $25 million a year to operate and will cost hundreds of millions of dollars to be able to re-tenant and, pay for tenant improvements and the building upgrades and fixing the deferred maintenance and all that. This is just the beginning, right? This sold via auction. And that group that sold via auction at this like 98% discount compared to what they pay, like that's clearly a forced seller, right? And it's only a matter of time until there's more forced sellers and there's going to be more and more of these buildings. And it's going to be really interesting. I agree. I think that, there's a price that you can buy anything at that probably makes sense. And I guess that price could be negative in certain cases, but yeah, it's going to be very interesting to see what happens with this particular asset that traded.
You see these smaller cities, and the formula is residential downtown, and the other piece of these formulas are government. And this, I know, John, that you're going to talk about the government on this, and I wanted to use this as a segue. Governments have the ability to help the process of either keeping downtowns vibrant or enhancing a downtown that's on the way to become vibrant, because they typically have huge requirements. And I tell you, I do a lot of work in Canada, and the Canadian provinces and the national government do this very well. There's I've found a real strong emphasis on bringing these requirements into the urban core and really helping revitalize it or continue to keep them strong. It's there's a lot less markets, there's a lot less sprawl as Canada is kind of centralized to a bunch of major cities, but I've noticed that they've been able to do it. So there's a formula there, and that's a good segue, John, into your article, which doesn't sound like it's trending in that direction, though.
Well, and I want to say, at the risk of being, all about doom, we're going to talk about something positive here and the opportunities around subleases. We're going to get to that next. But first, we're going to stay in this doom loop a little longer. I'm reading an article from Globist.com. The gentleman, Jack Rogers, wrote this on April 9th. Headline, Fed's only using 12% of office space at agency HQ in D.C. And I'm just going to read so I don't get it wrong. According to the Public Buildings Reform Board, federal government agencies are using an average of only 12% of the office space in their headquarters buildings in Washington, D.C. To put that in perspective, the General Services Administration, GSA, the government's real estate arm, owns or leases 90 million square feet in D.C., which makes it the city's largest occupant. The PBRB says the GSA's public building service is spending $2 billion a year to maintain government-owned agency office space, as well as $5 billion annually to lease space for government agencies, the lion's share of which are not being used. It continues. The PBRB, an independent federal agency created by the Federal Assets Transfer Act, is tasked with recommending the disposal of underutilized federal properties. According to the agency's new report, the massive scale of underutilized federal property creates an outsized opportunity to save money and improve outcomes through property disposals and smarter real estate decisions. They use anonymous cell phone data. This is how they determine that they're underutilized. At the Department of Labor's 1.9 million square foot headquarters, only about 441 workers use the offices on an average day in the building that costs $60 million to rent and operate. That's a crowd compared to the average daily turnout at the Department of Energy's 1.8 million square foot HQ on Independence Avenue, where PBRB says 8 people are using the building. 8. The report adds a caveat that this ultra-low headcount is likely to be flawed, but says PBRA reached out to the DOE for an explanation and did not get a response. Maybe nobody was there to answer the phone. One more 2 sentences. The results from the PBRB study indicate that the federal office occupancy problem actually is getting worse. A Government Accountability Office report last summer said a majority of government agencies were using 25% or less of their HQ capacity of 17 government agencies in 39 buildings, encompassing 21 million. So it used to be 25%, now it's 12. Brutal.
I'll tell you this, in my experience, in this small sliver of experience that I have with the federal government or the state government, is either working with clients or listening to developers or landlords talk about the process, or contractors and architects talk about the process to get permits or to go through any type of entitlements. And this isn't just in Boston. Boston's historically been, bad to worse in terms of the timeline to entitle property. 3 to 5 years is standard, but just standard, just regular permitting to do everything from minor to major renovations of space are extended massively. And if you ask people why, the answer I got the most, and there's a bunch of answers, but the answer I get the most is that people are working remotely and you just don't have the same volume of permits being approved. And that's just a small sliver, but if you just think about this from the perspective of the efficiency of the work that the government is doing on our behalf, and hopefully that means that people start to come back to the office, because it can't be as efficient as it would be, especially with the archaic technology that the government uses. They're not competing with Amazon and Apple to make their employees more efficient in the work from home environment, I don't think. So unfortunately, they're a little bit behind the curve historically. So it's scary to think that is the occupancy levels, and I think we all feel it in certain ways.
But what do you do? I mean, the solution isn't to dispose of excess real estate, I don't think. I mean, who would the buyer be in greater Washington, D.C., right? And then think about the second level and third level impacts of having empty office buildings on all the surrounding retail. And the solution is to sell off the buildings? I don't think so. The solution is to somehow get a functioning society that's interacting and a communal location. It's bigger than that. It's not about selling off the real estate, I don't think.
No, I think the answer is you got to get people back. I mean, you hear the mayor, I forget her name, but she's been kind of standing on the soapbox, pounding the table about getting people back to the office, because the economic impact to the city is profound, right? And the government being the largest tenant, they have her counterparts, or her, the federal government there has the ability to force that, and they're not. So it's interesting. We're trading kind of the overall socioeconomic vibrancy of our cities for, I think, the personal ease of our people, right? So it's people want to work from home, they do, but the downstream impact is profound. It's scary, and DC that's like the equivalent of San Francisco on the tech side, right? So San Fran's all tech, and they're doing the same thing. DC's all government, and they're doing it. So Boston, on the other hand, that's why it's such a hot market for investors, is we've got so many different levers of innovation and economic powerhouse and growth that we don't have the same, or New York with finance, we don't have the same impacts here as a lot of other markets, because there's just so many levers that are getting pulled in so many areas of growth. So maybe that's the answer, is it's time for DC to diversify out of purely being a government, a government market long term.
You're certainly coming on Boston proud strong today, Brian.
Got to do it. If it's not today, when is it? But I think San Francisco's trying to do it. There's a huge push for tough tech companies in the San Francisco markets, not just downtown, but overall on the peninsula. There's a big push for life science companies throughout the markets there on the peninsula. So what these urban centers need to do is diversify their employee base. I think everyone sees it and they know it. And for DC, I don't know if it's even possible, given who they are and what's there. But it's I think that's the answer long term. Is you can't be a one trick pony.
I wouldn't bet against the Bay Area because the money's there, right? The venture capital center of gravity, Stanford, smart folks. I wouldn't bet against the Bay Area.
I wouldn't either. I did just see a video, though, of apparently people, tow truck drivers are stealing cars on the street. So there was one video circulating that the driver of the tow truck is trying to steal a car that's being driven in traffic. So the tow truck's got the lift down, and he's backing up to try to get under the front wheels, and the cars continue to go backwards with him to stay off the truck. But it was, and in the article was talking about they're going around the streets and they're just picking up cars right on the street in front of whatever building, residential office buildings. So it's I never heard that before. It blew my mind a bit, but I think long term you're right, but short term they're going to be in for still some struggles out there.
Should we pivot and talk to you about some good news, the opportunity for tenants that are out leasing space and the great deals you can get under some subleases?
I mean, my approach to the subleasing is a buyer beware discussion right now, John. But you're right. And I'll tell you the parties at a later podcast. It's still too fresh and being played out as we speak. But I've got a situation here in Boston where someone took a very opportunistic sublease that was plug and play, that was 30 to 40% below market if you push all the costs into the deal. And unfortunately, the sub landlord, who is a public company that had okay financials, they certainly weren't IBM, but it was a tech company. They unfortunately have defaulted on their lease. And what we're finding as we advise the company and the people on this is that even in a situation where the landlord likes your tenancy, likes your use, but you just don't want to pay the direct cost of that market today, it's very expensive space, they're left with little opportunity then to effectively put you in default with them and force you potentially to leave the building, right? You don't have recognition. Even if you wanted it, a lot of times landlords aren't allowed to provide recognition because to get the sublease discharged, they have to go to court. So there's a kind of a window from when they terminate to the court discharging that lease legally, where they have control, but they don't have control of the space. And it puts you in limbo where if the company comes back and makes a claim on it and wants to cure, even if they don't cure, but they just go to the court and say, hey, I want to cure it, they may give them a period of time. So then your sublease potentially is back, but then you're paying rent to a company that is not paying rent, that hasn't cured yet. So it just creates this very difficult situation. At the end of the day, the final termination notice based upon the lease was a 5-day, not 5 business days. It was not, it was 5 days you have from the receipt of the termination to vacate the premises. And that's all IT, that's everything. You're going down in 5 days. So it's a very difficult situation. And one, you just have to be cautious. This particular company, they were well aware of it. They went into it with their eyes wide open. They could work from home very easily, very quickly. So they took the calculated risk, and unfortunately, it's playing out where they're going to have to find another solution because the space is going to be reclaimed. And I just do that as a cautionary tale because landlords, even when they want to work with you, sometimes they can't.
That's brutal. What percent of the master lease, how big was the discount from the rent being paid under the master lease on the sublease you're describing?
Yeah, like 40%, if you include, they put all the furniture in, FF&E. They might as well leave the soda in the fridge. It was one of those deals where they just left everything, monitors. So it's, on the pure rent side, it was about 30% discount, 20 to 30%. And then you throw all the CapEx at it and you're probably 40% discount over competing space.
But you're exactly right. Even if you could get a recognition agreement, it's going to only, you're only going to get it when you agree to step up to the rate paid in the master lease.
Exactly. Yeah. So it's almost like you don't even want it because if you're not willing to pay that rent, what's the point of getting it, right? And that recognition is going to recognize it through, it's not a short-term recognition. It's going to recognize it through the whole term of the lease. So you're actually putting yourself at a disadvantage if the sublease was to be terminated. The landlord would, when they get control, would get the same rent. In this case, there's actually a couple tenants on the floor that want to expand into the space too. So the landlord is looking at it opportunistically to say, like, you could step up, but we also have other tenants that are willing to step up around you if you don't.
One of the interesting considerations with these types of deals when you're doing a sublease with a sublandlord where you think there is some risk of default is what you do with the furniture, right? Generally, the rule of thumb in the industry is that if you, in the event of a sublandlord default, if you want to stay in the space, and then you'll just figure out a direct deal with the landlord at a much higher rate, that you make sure that you own the furniture as of, the first day of the lease, that part of the consideration of the sublease being signed is you purchasing the furniture via a separate bill of sale for like $1 on the, day that consent is provided. And then generally speaking, if you're sitting there saying, okay, I don't want to remain in this space, I can't pay the, 50% higher rent that will come with in the event of a default, then generally you don't want to own the furniture, right? Because otherwise you control all this furniture. You have to now deal with moving it out in that, 5-day period that Brian was talking about. And most likely you're going to go to another sublease anyways that will probably already be furnished. So I'm curious, Brian, in this particular case, what this company had negotiated for.
Yeah, so fortunately in this case, the furniture remains the property of the sublandlord. So we actually were trying to negotiate to get control of the furniture in the beginning because it's, in this market, plug and play space is so valuable, but there's very little of it here in Boston, and it leases very quickly. So our calculation was controlling the furniture so it would open up more options that are not furnished but are available that are built. And you could just bring the furniture with you. That was our calculation beyond the term of a 3-year sublease. But the company had kind of these visions of they were subleasing because they took down a large R&D requirement just on the other side of the city that brought together their engineers and their maker space and their office space together, and they went and took 50,000 feet, where this sublease was 6,000 feet. So they were like, but when we outgrow that, we're going to have to turn our office space in this makerspace building into more makerspace, and then we'll move back into our sublease, which is they're doing a 3-year deal. So it was kind of just a bridge. So in that case, they wouldn't give up the furniture. Now, fast forward, it's great because this particular requirement now goes to the market and doesn't have 2 sets of furniture. To your exact point, Tucker, they go and take another plug-and-play sublease. They don't have to worry about the landlord requiring them to go dispose of all of the furniture. Now, would they, honestly, in this market, furnished space leases first? I'm doing a deal where a tenant, we didn't even put the space on the market. They came to us and said, we'll do your entire term and almost your full rent because they don't want the CapEx. And it was all about the furniture in that case. So I think in this case, with a small piece of space, we would have been likely successful in negotiating to have the furniture remain. But your point is very good, that if you own it, then it becomes a liability at that point, towards if you're getting thrown out.
Yeah, but the problem with the way you described it, Tucker, is that the sublessor, I don't want to sell you the furniture during the term because the sublessee can default. And now you got a different problem. You got to get the space back. You got to release it again to another group, and you've given away the furniture. So you really can't transfer ownership of the furniture to a tenant except on the last day of the term. And better than transferring it for $1 on the final day of the lease term is for the sublessee to get an option to acquire it for $1 on the final day of the lease term. I think is the best way to handle the transfer of ownership of the furniture. And now, I never thought about it before, but thanks to this great story, I'm going to suggest the option to acquire the furniture on the final day of the lease term or in the event of a default. And it's just an option. So,
yeah, it depends on who you're representing. So, I have a sublease right now where I'm representing the sub landlord, my client, who no longer needs their space, and we've negotiated that the subtenant will purchase the furniture during the last month of the lease for $1, because we don't want to have to deal with getting it out of the building. We're going to be gone in new space by then anyway. So I think all this discussion, everybody, is a great segue just to emphasize that while sublease deals are great, okay, we've all done them, you've all heard about them. I mean, some of them are trading for pennies on the dollar relative to market rents. They all have their risks associated with them. And so whether or not you go with a sublease requires that you do your due diligence and ask that your representative performs that for you. And that's not just underwriting the financial solvency of that company you might be subleasing from, but also all the other risks that are inherent with being in a sublease. And so, just like Brian's story about how that company is now having to go out to the market and find new space, think about, let's say there is no issue. Let's say your sub-landlord performs per the prime lease and that you perform on your sublease. The lease expires in 3 years, and remarkably, the market has turned, and now we're back into sub 10% vacancy rates, and you happen to have been in a beautiful building, one that is top of market. Now what? When your rent goes from that sublease rent to something that might be 2 times what you might have been paying, you got to move again. And so for a longer term sublease, those things can make sense. But I've got people considering short term subleases that are less than 3 years of term. And while they're not phenomenal, they're certainly phenomenal deals, I have to advise that in call it 3 years, we're out in the market again. And this landlord's not going to recognize those terms you've been paying for the past 3 years with that sub-landlord. And so just be prepared for what's next, because it's easy to have that flight to quality mentality and go, gosh, this is an awesome slam dunk. But moving's disruptive, right? I mean, Brian, that company that you're talking about, I bet they're going to be spending $25,000 to $50,000 to move. Not to say that isn't, hugely substantial, but it's a pain. And that there's a disruption of having to move. So we could go on forever about this, but long story short, subleases are great. Just be mindful of what you're getting yourselves into so you don't make the wrong decisions and find out you have to deal with cleaning up a mess downstream.
Yeah, knowing we were going to talk about subleases, I just was thinking through what I might add to the conversation. I actually came up with 3 bullet points that I think are interesting. One of them is a lot like the circumstance you're describing. And it's this idea that you really, as a subtenant, as a sublessee, you really want to prevent the sublessor from unilaterally terminating the master lease. Things can happen. Suppose the landlord suddenly gets an opportunity to get Apple or Amazon on the full floor, and they'd rather you be gone. They can go to the tenant, offer to terminate the lease. They can go to the sublessor and offer to terminate the master lease for free. Or would the sublessor stick around on a losing proposition under a sublease, or just happily tear up the lease? So we want to say, the sublandlord, sublessor agrees not to terminate the master lease without our consent, which sublessee can withhold in their sole discretion. I've seen that happen where, suddenly you're attached in a sublease, you're attached to the sublandlord who's attached to the master landlord, but they can get wiped out and then you're left holding nothing.
Yeah. And John, just to that point, in this particular, because you don't have a contractual relationship with the landlord. So the notices in the sublease, the notices of default they sent 4 notices of default, apparently, to the tenant. And in our sublease, in their sublease, they have a notice provision where the sub-landlord needs to provide to the subtenant any notices they get from the master landlord. Well, they've gone completely dark, and they're not responding, they're not paying rent, they're not doing anything. So these notices have gone to the sub-landlord. The subtenant had no idea this was happening because the landlord can't send them and can't notify them legally because there's no contractual relationship. So it was us as the brokers who they called and knew that we were involved to say, guys, this is what's going on. You need to get your head around it, but we can't send you copies of the notices. We can't send your client copies of the notices because we don't have a relationship with them, and our lawyers are saying we can't do it. So it all kind of came to a head because of relationships with the brokers behind the scenes, but it's a little scary because your client potentially doesn't have any heads up that all this time is happening because the performance of the sub-landlord isn't there at all. They're not doing anything. They're not paying rent. They're not forwarding notices. They're not communicating. The client had reached out to everybody at the company. The CFO was gone. The new CFO wouldn't respond. The CEO wouldn't respond. And and it was completely radio silent. So you just have to, I think for me, as you look, everybody thinks a recognition agreement, or they think all without proper guidance, people will think that all sublandlords are the same. And it's really just about the space and how great the space is. I think the due diligence and the education on the what ifs, if there's an issue with your sublandlord, and educating your clients on that is really important, because if you think about it, you go around, you look at these spaces, and you could have great space from A plus credit company competing with amazing space from a company with no credit. That, and you see this a lot in the life science space, John, right? So you have these companies that are subleasing space that they have their runways are under a year, under 6 months of cash, and the space is exactly what you want. Now what happens? Do you take it? I think there's a lot of work that needs to go in that between those. There needs to be differentiation in the market, or a lot more work that needs to be done to protect your clients in that situation and protect your company, really. Because our listeners that are directors of real estate are doing transactions, and you move into space, and then a short time later you turn around and you got to tell your leadership that this is what's happening, and it's like, well, what could we have done differently? And maybe the answer is nothing, and everyone's aware, and everyone makes a calculated decision, and that's a perfect world, and it is what it is. But a lot of times, I think companies are getting into situations that they don't understand the downside risk.
Sublandlord security deposits. I'm not sure they could be big enough. They could buy you a few months, but letter of credit for performance under the lease. I don't know. I do have one other fun idea. This is just something I did for a client that I feel it was kind of clever, and I felt good about it. Many of you guys already do this, but we took down a sublease. We got all the FF&E, which is great, right? All that cabling is so expensive. But this space had beautiful art on the walls, so we got the art. Yeah, why not get the art? Just a thought.
I tried once to get artwork from someone, and it was, I forget what the situation, but they turned around like, "Do you know what that art is?" And I'm like, it looks nice. It ended up being a multi-million-dollar piece of artwork the only reason it was still on the wall is that it had to go through this process to get taken down and packaged and sent. So it was the last piece in the space. I'm like, yeah, I guess they didn't want it. No, they're waiting for the really expensive movers they're gonna come with the white gloves on and take that one down. I was like, oh, okay, sorry. I didn't recognize it that well. But yeah, why not throw it all in? Take the soda in the fridge.
Well, with that, let's transition to something different than subleases. Let's talk about industrial real estate. We've talked about that a fair amount in this pod. And slightly like what we've talked about in the past, with office space, we're starting to see rents slip and decline based on lack of demand. And I don't want to suggest that it's lack of demand like office space. It isn't, but it's certainly starting to fall. And during the pandemic, I think it would be hard to argue that there was a hotter industrial submarket than the Inland Empire, and maybe even Long Beach in California. And granted, those are two markets that I don't serve specifically in my day-to-day. I do have clients that occupy both, and so I'm familiar enough with the market where I knew what was going on based on some transactions I worked on. And there was an article, when things start, you often probably hear me quote the Wall Street Journal. It's my favorite paper. I read it every single morning, cover to cover, not every single article, but I certainly page through every page. And in today's issue, there was an article about industrial rents slipping in, guess what, the Inland Empire. And this put a smile on my face because it was so frenetic and so hot for so long. You had tenants vying for a building, while four others in some cases were competing for the same asset. It was absolutely nuts. I'd never seen anything like it. And we were starting to see rents start to flatten across industrial space around the entire country, but specifically the Inland Empire and in Long Beach. And so there are statistics that came out recently that said that in the first quarter alone, we started to see rents fall in this area, nearly 3%, which is significant because again, rates were going up in some cases double digit year over year during the pandemic. And this is also why, while warehouse vacancy across the country is now sitting at 5.8% for the first quarter, up from 5.2% in Q4 of last year. And so we're still seeing rates that are historically low. I want to put that into perspective for you. I'm not suggesting we're at all-time highs, but significantly up from what we were seeing in late 2022, where we saw national industrial vacancy rates at about 3%. So I'm smiling as I say this because this is good news for our clients. That we're getting back towards what I would consider to be an equilibrium between a landlord and a tenant market. And there's more to come. I don't think we've seen the last of it. I think we're going to continue to see some sublease availability hit the market, some additional vacancy on a direct basis as well. And we'd love to hear what others have to say. So, Tucker, what do you have any thoughts on this?
Yeah, we talked about this a little bit on the last episode, but when you look at the industrial vacancy and availability in the Inland Empire specifically, there's nearly 2.5 times the amount of space that is vacant, and also a similar ratio on the availability side. And that's off of a really low number to begin with, right? But when you hear things like, hey, rents have come down by 3%, I think that is dramatically understated. The reality is that rents have come down by far more than that already. And when you start thinking about just the like really exuberant environment we had, sort of beginning maybe 6 months into COVID and sort of starting to slow down in, like late 2022, early 2023, there was so much competition for every single building in the Inland Empire that prices just went up in a crazy manner. I mean, there were scenarios where we had clients telling us like, hey, look, I'm going to make $10 million a year if I can get this building. And if I have to pay an extra $2 million in rent, I still make $8 million a year. And that, $2 million additional rent that they're paying might have amounted to 30 or 40 cents a square foot. And that's just no longer the case. Like that opportunity doesn't exist anymore, yet prices are still settled at that very above equilibrium amount. So it feels like, given the amount of increased space that is on the market, given the prices that businesses can sustain, that this is probably just the beginning and that we're going to see more downward pressure on rents. And then it becomes a matter of like, how hard can landlords hold to this pricing? How long can they last? What is their tolerance for vacancy? So it will be really interesting to see. But yeah, Owen, it's definitely interesting to see the amount of space that's coming on the market, and also interesting that many people, and this is reflected in cap rates too, many people have regarded sort of these like core industrial markets as by far the safest, by far the most resilient, the markets that are going to grow at the fastest rate. And it's turning out that some of these like most resilient industrial markets actually were the fastest to have price increases, but also may end up being the fastest to have price decreases as well, because these much smaller markets that are more supply constrained than like say the Inland Empire is, are just not seeing the same availability rates and the same reductions in rental rates that we're seeing in certain areas like the Inland Empire.
That story you told about someone saying they're willing to pay an extra $2 million in rent because they were going to make $10 million and now they only make $8 million reminds me of the mentality of office companies taking down office space during the dot-com boom. Like, hey, we need an extra floor because when we need it, we need to get those people there because we're going to make so much money that we need to continue to bank space and stay ahead of it, right? And it's that mentality where they never predict a slowdown in demand that you've seen across different sectors that always comes. And at that point, you're going to have too much space. And where's that equilibrium of supply and demand that a lot of prudent companies have made? I think you get a little bit over your ski tips, and I think industrial leasing got there, right? Amazon drove companies mad because they were just so out ahead of it, and they were just eating up such amounts of supply that companies needed to compete with that. Well, Amazon's dried up, although I did just see an announcement that they're going to be expanding their warehouses for their last mile fresh food distribution across the country. They announced that, I think, last week. But I think as the major players, the Walmarts, Amazons, slow down their growth, that mentality should be equally slowed down, and companies can be more prudent about their expansion, which to me means they lease less space.
Okay, so I think we're onto something here, and I'm going to give it a name. In the tech bubble, you had people taking down floors for future expansion. And I'm going to call it defensive expansion, right? And of course that, then the music stops, musical chairs, and it all settles out. They've got more real estate they need because they were taking on space they actually didn't need yet. You're saying that's appearing to happen now in industrial. I can point to lab space, life science, and say the exact same thing. That was very much the case leading into the most recent turn in the lab market, where companies were taking down defensive expansion. And it happened so fast in the life science space that these companies are left holding the bag on space they don't need and didn't need, but they felt the need to acquire it, capture it with this defensive expansion. So going forward, why don't we all put this into your long-term memory? I would suggest that the defensive expansion is an indicator of an imminent bubble.
So, John, another point to support that kind of bubble mentality. I am working with a client on a strategic consolidation of office space, and it's roughly 75 to 150,000 feet. And it's, as we're looking at the marketplace, half of the buildings that are being considered, or on the initial survey, I shouldn't say being considered, on the initial survey, and there's not a lot in this particular area where they're looking, are second generation industrial buildings that would be converted into large scale office, single story office buildings. And, I think the market over the last 5 years has gone significantly in the other direction, right? Taking the second, third generation old buildings that had been used as office or converted into office and making them industrial. Now they don't check all the boxes of core industrial, right? They've got 24-foot or 22-foot ceilings, or worst case 18-foot ceilings. They don't have the ability to do cross docks in the way that a company would want if they were building a new building. But because of the demand in the marketplace and the price differential, they were being supported as industrial buildings again, and they were leased. Now that's dried up. So these landlords have bought these buildings, have put the capital into them, and now are saying, you know what, we could pop windows in the exterior of this. We could make it really nice office space. So it's just kind of funny. You're seeing that they're trying to be able to play the whole market rather than just going all in on one particular sector.
And to be clear, John, I don't think that there is any defensive expansion happening right now, right? That was all that was happening in 2020, 2021 on the industrial side. I definitely think that is a good indicator of potential, euphoria and bubble bursting being relatively imminent. Certainly not, hey, this is guaranteed to happen in the next couple of months, but I think generally there's pretty high probability that within the next 24, 36 months from the time that companies start engaging in this defensive expansion type of behavior, that usually means that there's a lot of risk that's coming. I would say that you would have to also look at the supply of new construction that's being delivered into that defensive expansion market, right? Because the development community, the landlord community is, of course, responding to the stimulus of, whoa, rents are exploding. We need to figure out how to be a life sciences landlord. We need to figure out how to be an industrial landlord. Something that I think is interesting to point out that Brian was talking about a little bit earlier that is a bit tangential is just about Amazon's like cold storage expansion to be able to do, distribution of seafood and other frozen products. That will not have a material impact on the industrial market whatsoever. Cold storage is so specialized, and Brian, of course, knows this, has a lot of experience in the cold storage space, but just to point out for our listeners, it's such a small segment of the overall US industrial market, and the cost to build refrigerated and frozen industrial space is so wildly high, and it's very concentrated in terms of the types of owners that own that, right? There's the, Prologis Blackstone equivalent in the cold storage that holds even greater, monopoly on this type of space. So I wouldn't expect Amazon gobbling up, converting some industrial buildings or converting some development sites that otherwise would be more traditional industrial logistics type warehouses to cold storage to have any impact at all.
Yeah, unlike industrial, I think there's only one publicly traded REIT that plays in the cold storage space. It's called Americold. But Tucker's spot on for our listeners. I mean, it's a very small segment of the overall market, and representative by there's only one REIT. Think how many office industrial REITs there are. I mean, hundreds.
It's Americold and then Lineage Logistics that are the two really, really big owners. And they have massive share. I think that I believe there's a third and fourth that are quite distant, but yeah, if you're, seeing a cold storage development site pop up, there's a very good chance that it's one of the two of them that are building it or, involved in some manner or another. But really interesting episode 33, covered a lot of ground. Doom loop to what the government's doing, to talking about industrial, talking about subleasing. Brian, I hope that your mystery group that is in this situation has a amicable resolution here shortly. And with that, we'll wrap the episode and we'll be back soon with episode 34. Thank you.